All right, good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wehner, and we are talking today about a concept really that is how can you potentially deduct your whole life insurance premiums? And so, what I want to tell you today is that we have a really great conversation, and this is based on a lot of people would think about whole life insurance, you're in a position where you are using this tax advantaged tool to pay tax on premium dollars before you put them into the policy. You put premium dollars into the policy post tax. This isn't a typical situation. And you're now growing that money tax deferred. You are able to access it tax free through policy loans or withdrawals up to your cost basis or what you've put into the policy, and then it pays out income tax free to your heirs. This is a tax advantage tool that typically you pay tax on premiums before you put them in the policy. And it's this concept of, would you rather pay tax on the seed or the harvest? You pay tax on the seed, then you grow it inside of a life insurance policy and you're in a position of not having to pay tax on the harvest. This is opposite of a typical way of tax deferral, where you don't pay tax today and you put money into something like a qualified plan, a 401k or an IRA. You don't pay tax today and you do pay tax in the future. So today we're talking about this landscape and then how you potentially have the opportunity to deduct your premiums, which means how could you potentially not pay tax on the money that goes into a policy? So before you get up in arms about this conversation, just know that we're asking the question and we're talking about ways that you have possible strategy and strategic nature of being able to think holistically about everything that you're doing. And there's pros and cons again to every situation. And that's what we're here to talk with you about today. So, Bruce, thank you for joining me for this question and for this conversation because I think it's really important to people who are making strategic financial decisions.
Yeah, and I think the first thing we need to say is obviously we are not giving any tax advice. Um, we are not tax professionals. This is merely for conversational purposes, and that anything that you do personally or with your business, you need to contact your tax professional or a competent tax a professional. I would tend to lean more on from a business aspect to contact a tax attorney, not just because the tax attorney is a CPA is really good at applying the tax laws from the IRS. A tax attorney would interpret the tax laws from the IRS. So that would be the difference. So today we're just going to talk about why people think they can or why people think they cannot deduct these from their business as business expenses, and possible ways that it might make sense that you could present it to your CPA or tax attorney to see if it makes sense to them.
Excellent. So, Bruce, is there any context or framework that you think we need to lay out besides what I just kind of spelled out with the typical way that you would think about the taxability of whole life insurance and that contrasted with the taxability of tax deferred vehicles, just to get the lay of the land for maybe a regular situation before we dive in?
Well, obviously, if you're a business owner, one of the advantages, there's two different types of tax codes. And Tom Wheelwright, Robert Kiyosaki's CPA, talks about this all the time. There is a W-2 tax code, and there is a business owner 1099 or independent contractor tax code. And one of them is just a series, or everything in the IRS is a series of incentives, Wheelwright always says, to get the behavior that Congress wishes to get the behavior of people in the United States. So when they make business expenses deductible, then what Congress is trying to do, in my opinion, is they are trying to spur business ownership in the United States. Because when that happens, then you have people that want to start a business take the risk of starting a business to profit from their value that they're giving society. And one of those values they're giving society is that they are putting other people to work that do not have to have the capital, do not have to take the risk of the losing the capital through a business failing. So one of the ways a business can become more successful is if they can deduct the actual expenses of the business, because that's not reflecting the profit. It is actually against the revenue. So this is very common mistake that people see all the time. They say, "Oh, well, so and so made $500,000 in revenue. They're making a lot of money." But what they forget is there's a lot of expenses along the way. If they have employees, obviously, not only the wages they pay those employees, but the workers' comp premiums, the insurance premiums, the Social Security that they must pay on their behalf, um, any kind of expenses as far as uniform, maybe lunch expenses, all those kind of things. And then they have to purchase inventory, and inventory, unless you're strictly a service base, inventory. Obviously, if you buy something for $5 and you sell it for $10, that $10 doesn't go all into your pocket as profit, because you had to expend $5 to make $10. So the government says you can write off the what they call cost of goods, which is the $5. So you don't have to pay on that. So the entire tax code is written so that you can write off expenses. So this is where it gets confusing for people, because what they're saying is, well, then why can't I write off my life insurance premiums? You can write off life insurance premiums if you have no ownership of those premiums. What would that be? Well, in a business, a lot of times it's just group term insurance for your employees. So you could write those off as a business expense.
In the
However,
case where the person benefiting is not the business owner.
correct, correct. And this is the interpretation that has been told to me in the past. However, if you have a life insurance policy that you are taking out on your own life and the business owns, that you're going to benefit and you're part owner of the business, and I believe there is a percentage of ownership that is also with this, then you cannot make that tax deductible, because you're actually, and I tell this to people all the time that ask me this question. I say, I'm not the expert, but this is what's been told to me. Does it make any sense that you are going to be able to deduct the premiums? You're going to be able to access the money tax-free, and your heirs are going to get the tax-free death benefit, the income tax-free death benefit. So you've never paid taxes on it. And there's only one thing that I know that actually works like that in the tax code, and that's the HSA, where you actually can deduct those premiums. Well, actually, it's not even really a premium. It's
It's like contributions, right?
a contribution. You get to deduct that, and then you get to access that to pay for qualified medical. So that's the only thing that I know of that works like that, where you get to deduct it and access it tax free.
Bruce, you said a lot here.
So yeah, we'll dive into this a little deeper on how you could or could not.
I think what's really interesting, I want to go back and just kind of recap a couple of the points that you made. And one is that the tax code is intended to be an incentive for production. And you could look at this as being unfair, right? Because you have people who are business owners who can take advantage and leverage the tax code in their favor, because there's so many ways to have deductions, and there's so many elements of the tax strategy available to business owners. But it makes sense because the tax code is incentivizing production. So when you look at tax alone, you could say, well, the number one tax advantage that I can gain is to set up some kind of business ownership. You can be in a position of business ownership rather than just having your income come from a W-2. And this might not necessarily be operating a brick and mortar business. This could be an online business. This could be a service-based business. It could also be real estate business. When you have something that you can form an entity around, whether it's an S corp or an LLC, you are in a position of having advantages in the tax code that you would not otherwise have. So that's one thing I just want to clarify, or not clarify, but add to. Another point, Bruce, I still remember the first conversation I had with a business owner that where this awareness came to me, exactly what you're talking about before, where they were making nearly, I mean, just shy of $1 million in revenue. And everyone is looking at that and saying, great business, wonderful business. The amount that they had in profit was negative. So they were very much struggling. And you could look at that and say, oh, they make so much money. What's the problem? Well, exactly what you were saying. The amount of expenses, I mean, this could be the building that you're renting and the equipment you're renting or paying for, your utilities. This is all of the costs that go into operating the business in addition to even the things that you said, Bruce. And I think that can be the temptation or um the sh the lack of understanding that can happen when you're not a business owner to look at a business owner and say they make tons of money. There is also a lot of expenses associated with running a business that you might not be aware of. And so that I just wanted to accentuate that point that you had. The other component is I'll credit Garrett Gunderson on this. He says not to let the tax tail wag the dog. And what he means is that if you are in a position where you're using taxes to make your financial decisions, you're probably not going to end up in the right financial strategy. And the reason I'm going to say this is because if you are just trying to minimize tax, you might end up doing things that are actually disadvantaging you, that are disadvantageous. I don't know if that's even a word. I'm probably making that up, but that are not in your favor. You might take on expenses and purchase things to uh, boost up your expenses that you really didn't need for the operation of the business, lowering your profitability in order to reduce your taxes in business. And that's not a good move. It's not strategic in your favor. You're actually not having the income that you should. Or if you're saying, I don't want to make so much money because I don't want to have to pay more taxes. That's also not a situation where you want to allow the fear of having to pay higher taxes to prevent you from the profitability that you could have in your business. And so that was just on the tax tail situation. I also just wanted to point out, Bruce, you say so many times over and over again that it's not about tax loopholes, but tax incentives. And I think the challenge is if we're looking for loopholes and we're trying to find a loophole and get into that loophole, we're going to be trying to say, how do we never pay tax on money? And the challenge with that is you might be trying to do something that is not really intended or not really in your favor. And Bruce, I think that's exactly what you're talking about when you're saying it wouldn't make any sense for someone, for the government to say, well, you never have to pay tax on this money at all. But how do we strategically minimize the tax that you need to pay so that you can keep as much of it as possible and you're in a position of being tax advantaged, not looking for loopholes, but using the incentives, using them the way they're intended to the way the tax code is intended to be used.
Yes, very good. So what I think is interesting is I have business clients all the time that say, well, when we're setting this up, can I use this as a business expense? And I tell them I think it's very clear from the tax attorneys that I've talked to through it actually went to the Supreme Court, held that when a loan transaction or um, a premium is deductible, it lacks no economic substance, no indebtedness exists, and interest on such loans is not deductible. A transaction will be determined to be lacking in economic substance or a sham transaction when there is nothing of substance to be realized beyond a tax deduction. So I think it's pretty clear from the Supreme Court that the Supreme Court does not believe, especially interest, but then they also talk about the premiums because you are actually not losing anything from that premium. You're actually going to be gaining money from a leveraged up death benefit. And that's where the argument with the interest is. It's like, yes, you're paying interest, but all the interest is doing is lowering the death benefit, which the death benefit is always already leveraged up greatly from the premium that you paid. So they're saying you really are not doing any economic harm from the interest that you're paying.
Okay,
So
so Bruce, can we unpack that a little more? Because I want to make sure I understand fully. So basically, what I think the Supreme Court decision was saying is that if you're just shuffling money from paying premium and having if the premium's deductible, then that was a sham transaction that there's no economic advantage to. Is there something I'm lacking in my understanding of that one context? Like they're basically saying you should not have a deductible premium.
correct, because you're not losing anything economically. You're actually gaining economically, which is a leveraged up death benefit that's going to be passed along tax free.
Okay. And then on the interest component, when you said paying interest, you mean paying interest on loans or
Yeah.
okay, so they're saying you should not have to pay tax on or
Saying
explain that a little bit more.
no, they're saying that because cannot deduct interest on loans either, because for the same reason, even though that is an expense to your business, but that all that expense is not really coming out of your money. So you're not losing anything economically. It's just being held against the death benefit. So, yes, the death benefit is being reduced. However, the business isn't feeling any pain of that interest.
Okay.
So,
So
the
this
interpretation of the Supreme
so,
Court.
so the Supreme Court's interpretation basically was against deducting premiums and also against deducting interest, even when paid by a business. Correct.
Well, for your own personal gain, if it's premiums for other people that you don't have, you're not getting access to the to the cash value loans or for the death benefit, then that's okay. You can write those premiums off. But any premiums that are the death benefit is going to go to your estate, then they say then you don't really have any economic loss from the interest or the premiums. You're actually getting Nelson Nash used to say this all the time. If you knew that you were going to get back every premium dollar you ever put in at the time of your death, tax free, how much would you want to put in?
As
So,
much as you can.
right. So the premium you're getting back, there's no economic loss. Matter of fact, there's still an economic gain from that. And that's what the Supreme Court said in this precedent, and there's other precedents for this. Um,
Excellent.
but what happens here is that there are people that said, well, okay, what if I loan it for an investment? Because if you buy stocks on margin, or if you loan money to your business, or you go get a business loan and you go buy equipment, that equipment is tax deductible. That's an investment in the business. So why can't you do the same thing here? And so that's the argument a lot of people will say. None of them that I've no tax attorneys or CPAs that I'm affiliated with have ever said that to me. But other business owners that I've dealt with said, no, my tax attorney says this. So you really need to look at it. But from my point of view, from the people I trust, I would not deduct the premiums or the loan interest. However, we are going to talk about a way that maybe some businesses can reduce their tax liability through deductions, and then that increased flow of cash profits could be used to pay your premiums.
So, Bruce, let's go ahead and talk about that. So, a way that a business owner can reduce tax liability with deductions and use that increased profitability to pay premiums. Let's go ahead and talk about that.
So the two ways that I really do it. The main way is that my father is a marketing person for my business. He's in a much lower tax rate. So I have business cards for him, and he then hands out business cards to potential clients, and then I pay him every month to do that. So at the end of the year, he might have $10,000 of salary, but because of his other deductions and because his Social Security is not taxed at the same rate as regular income, he is never out of the 10% tax bracket. So then any money I shift to him, he actually then is not money that takes off of my taxes, which on any given year, depending on our investments, so on and so forth, I will be in it. My wife and I will be anywhere from 24 to 32%. So then if it's 10,000, that's $3,200 on a 32% tax bracket. Plus in Missouri, it's another 4%. So it's $3,600 that I save in taxes that I now can use to pay insurance premiums with. Now, I don't have any children, but you could do the same thing if you had children in your life that are age appropriate and can do certain things for your business, that they could actually be doing things in the business, but there's a standard deduction of around, I believe this year it's a little over 13,500. So as long as they don't get paid more than 13,500, that money actually leaves your business, pays them, but they get to deduct 13,500. And now they don't pay any income tax, but you would have paid income tax and state tax on federal income tax and federal and then state income tax on that 13,500. That then could be used to pay insurance premiums. But now I can hear some people, because we have really intelligent viewers, listeners, they're saying, yeah, but you don't have that money anymore. Well, yeah, but now other monies that you may use in your personal economy to pay for kids' expenses, now your own kids can pay for those expenses. So now they have their own money, so the money doesn't have to flow out of your own economy to the kids on that side of it. So you don't have to take additional dividend distributions from your business to pay for those additional kids, because if you do that, then that is additional revenue, not expense, out of the business. So you have to pay taxes on it. So those are the two ways that most people can find additional deductions, and those are just two ways that you can find additional deductions out of the business that are very legal, as long as your parent or your children do legitimate things in your business to actually save on taxes that could be used as premiums.
So, Bruce, I mean, in all honesty, and we're admitting to the world here, we don't pay our kids this way yet. But what I see is the capability for doing that. So I'm going to ask you a couple questions, but also share what we are doing that's towards this idea as well. So we love the idea of shifting expenses to the kids that they need to pay for, and rather than us paying for things. And so we decided to do this probably about close 9 months to a year ago, where we have house gigs for our kids to do. And this is on the personal side. So I guess we could probably do it on the business side and be a little bit more advantageous in the tax component. But we have chores that they are required to do just as a part of being part of the family. I mean, they have to make their beds, they have to put away their laundry. One of our older daughter has to wash her own laundry. They have to, help clean the dishwasher, take out the trash. And this is just part of being in the family. But then there's additional chores that are more valuable to the family and require a little bit more intentionality, and they're serving the whole family. So we have our older daughter vacuum the whole house and she cleans the bathrooms and things like that. So we pay then for certain types of chores. And when we do that, then we shift some of the expenses that we were covering, whether it's dance, tuition or recital costumes, or our older daughter is paying for dog food, things like that are shifted then for the kids to take ownership and responsibility of. And what I love about this is actually not even a tax play, but a responsibility play. So the kids then are taking on more ownership of things that are not just their own space that they have to manage and maintain, but they're also thinking of how they can serve the family. And they're always asking, how can I earn more money? So that's a great question. And they always want to be thinking about, well, maybe if I clean the upstairs windows, can I also get paid more money? Things like that. So we then are shifting over the expenses to them. I see that we could do this on the business side as well. There's not as many things that they could do in serving the business. Our older daughter, certainly, but the younger one, I mean, we're mostly paperless. There's not a lot of filing that needs to be done or shredding. I mean, those would be the kinds of things that maybe a 5-year-old could do. Obviously, our almost 2-year-old can't really do much in the business. So we're not taking advantage of that in as much of a way that we could. So that's partially just something that you can think about, but also just an admission that we're not perfect in all the things that we're doing. So there's things that are available to us that we could leverage even more. But I want to go to the idea of then how could you, especially with kids or in your father's situation, if you're paying someone else who is in a lower tax situation, or they're being paid less total than the standard deduction and not having to pay tax on that money. Now, how can you use that to pay life insurance premium? Because technically, then the children could pay life insurance premiums, or your father can pay life insurance premiums with money that they're paid from you, from the business as well, correct?
Yeah, yes. And that's what he does. He has life insurance, two contracts also. So, I'm not saying it goes into it. That money that I pay him goes into the checking account and that it immediately goes to the life insurance premiums, but it's still capital that's being accumulated to
Mm-hmm.
pay for that. So that is definitely something that um, could happen. It could, whatever capital could go pay for life insurance for him. Now he doesn't have his own business, so and because his estate would gain it once again, he couldn't write those premiums off of his own life insurance, even if he had a business, because it's the same thing that I'm talking about.
So that would actually be better in a situation with children that you're paying that their income is not more than
Yes.
12,500, or if they're under the standard deduction, then they could use that money to pay premiums.
Yeah, it gets a little more complicated because my father actually and my mother actually lost 50% of their tax deferred money in
Mm,
2008.
no, I'm
And
sorry.
yeah, and then so I had decided, and I wasn't the financial advisor because I think I've talked about this on the podcast before. You cannot find a non-German on my family tree, and my dad just did not talk about money situations with me. So he had somebody else, and he finally then asked if I could help him. And this
Mm,
solution, instead of just handing them money all the time, that I would make him an employee, and we would buy a life insurance policy on him. I don't deduct the premiums. I don't deduct the premiums on him. But my wife and we do pay them extra, not only the W-2, but there's times when we pay extra because they need something. They had to downsize their house one time, and they had to do a roof on their house. So we
mm.
helped them with that. And so at the time of his death, even though we can't deduct that from our business, we will actually gain that money back from the death benefit, all the money that and more that we have been giving them. So any way that we can lower our expenses by making him an employee, and he has gotten me clients before by handing
That's
out.
awesome.
Yeah. So because he likes to talk to everybody, and so on and so forth. And he
That's not
just,
surprising, Bruce.
yeah. And so,
That's awesome.
so it is a legitimate, business expense because I can prove it from the clients that he's sent my way. So there are other things, Rachel, you already touched upon, getting away from personnel now, you already touched upon is if you if you have a tax liability of say 40,000, or let's say you have no, at the end of the year, you have no tax liability. It comes to zero, but before the end of the year, you decide I need to buy a piece of equipment to actually enhance my business. Now, I think this is where you were going earlier. It's because a lot of people will just go out and buy equipment just to lower their taxes. This is what Garrett Gunnarson's talking about.
Hmm.
And I've seen this a lot with business owners.
The fancy new truck, right?
Yeah, I was just going to say a new dump truck. We have contractors that have a metal business, and they were going to owe a bunch of money, so they went out and bought another dump truck just so that they could lower it. But now they had to pay some capital down payment, and now they're making interest payments on top of which are deductible. However, it's money that's flowing out now, which is going to be greater than the tax liability eventually. And they're not really increasing any of the capital that's coming into business from this dump truck because they had this other truck that was working perfectly. But their CPA said to them, well, if you want, you got to buy a piece of equipment before the end of the year. If you don't want to pay anything on April 15th. And
Yeah.
this is not a one-off thing. This happens all the time with CPAs. But let's say you do need let's say you've increased your business so much that you do need another dump truck. So now you had no tax liability. You buy a dump truck for $250,000 and you use some of the bonus depreciation where you can deduct almost all of it, or even if you only deduct 50% of it. And now you get a tax refund of 40,000. You could then take that tax refund of 40,000, buy a life insurance policy, capitalize the life insurance policy. You're going to have access to a significant portion of that 40,000 within 30 days. Then you could use that to actually fund additional things to make your business even more profitable. And then you just rinse and repeat to make the premium payments.
So this is why you need to talk to a life insurance strategist who can not only understand what is going on in your financial economy and not just think about how do I pay initial premiums or what initial policy design do I set up and then just set it and forget it. Really, this is why you want to be in a regular relationship with somebody who can help you continue to make those decisions to navigate when is the appropriate use of capital, what I want to purchase this thing in my business and maybe how can I do that most effectively? How can I grow my life insurance policies? How can I build my banking system? Who can I put additional policies on? Where can I find additional capital to put into this whole system of growing wealth through infinite banking and through using strategic whole life insurance?
Listen, we have our own tax department at E3, and I understand why there's a temptation to tell people to do something so they don't have to pay their taxes this year or they get a refund. One, it makes you look better because all of a
Mhm.
sudden you're like, look how smart I was. I actually got you a refund or you didn't have to pay taxes. However, you're paying out additional capital for that piece of equipment. And that's fine if it's actually getting you more revenue. But if it's not, then you really only are solving a problem for one time. And as Fritz just said, CPAs seem to have a blind side, solving one problem, but adding another problem as a result. And then Rob says CPAs use reactive tax strategies instead of proactive tax strategies. And I'm not saying that every CPA is like this, but it's a really high majority. Now, the other thing you have to figure in on it is that money today is worth more today than it will be in the future. So you could argue that maybe a tax refund with an additional capital expenditure might zero out sometime in the future, but it's also, you have to ask. I always tell people, whenever you're trying to do anything tax wise, you should say, is this only going to save me taxes today, or is it going to save me more taxes over my lifetime? That's the decision making. And you have to have somebody that can run those scenarios for you. And it's not an exact science, because we don't know where tax rates are going to be in the future. We don't know what the investment into your business is going to reap. We don't know any of those things, but at least you have to start by asking that question. Is it going to save me more taxes this year, or is it going to save me more taxes into the future?
Which,
So,
Bruce, that's Nelson's concept. That's one of his principles, to think long range. And I think the challenge is in our human nature to think about what is right in front of us. It's in every situation. It's, how do I get this solved the fastest? How do I have the fastest meal preparation? How do I microwave this rather than have a slow cooking process? How do I, make $1 million today? How do I have a flashy investment that I'm a millionaire, I'm successful overnight? Most things that are worth doing are long plays, though. And I think we need to, if we could shift our mindset to look at the lifetime advantage of every decision we make, we're going to make better decisions. It just doesn't feel like that necessarily in the moment, where we feel like I just need to make sure that I have as much capital tomorrow. We're not thinking about, how do I have the maximum capital for my lifetime? How do I fund as many investments and businesses over my lifetime? How do I maximize my generational capital? How do I make decisions that are going to benefit my children and grandchildren? And that's the thinking that truly will set you up for better decision making. And I think one of the things that is a telling way of doing this, that is a completely unrelated example, is that in our parenting, it's so easy to make decisions about what is going to make our kids the happiest right now, which means I'm going to give in to their demands and their temper tantrums, and they're going to get a lollipop, and they're going to get to eat popsicles for dinner and ice cream for breakfast, because I just want them to be happy. The problem with that is, not only are they going to have rotten teeth, a terrible temper, they're going to be running your household, you're going to be running ragged all around them, you're going to be in a position where you made them the center of the universe and now you're paying for it. Instead, if we did not just drive at our kids' immediate happiness, but we instead thought about, how am I raising my grandchildren's parents? How am I raising this child to be a good mother or a good father of their children, and be able to teach them principles of success, and have to make hard decisions in their own parenting, even when I just look at my 3-year-old and my 5-year-old today and I say, how can I help them have the life skills to make long-term decisions in their parenting? That's a long-range thinking perspective. Most of us don't do that. The first time I heard this idea, I thought, this is so radical, I don't even know how to wrap my mind around it. And then I considered this more deeply, and I realized, if we can make the longest range decisions, we absolutely will be the most successful. So, Bruce, that is exactly true in even the tax scenario. Not how do I avoid the tax line today, but will this reduce my taxes for my lifetime? Such a
Yeah,
clarifying question.
yeah, and like I said, I don't blame people. We've lost a sense of decorum in our society. The tax code has become very, very complex and onerous to tax preparers and CPAs, enrolled agents, what they're called, the tax preparer enrolled agents, and they are wore out. They are really wore out. They usually try to spend the entire year after tax season. They try to spend it getting up on their knowledge of the changes in the tax code. Then January 1st rolls around, and by February 1st, they start doing taxes, and they have basically February, March, and half of April to get the taxes finished. And if it's a business return, they have until March 15th. So they have 6 weeks to get it done. They're worn ragged. People don't get the amount of information to them on time, but they get it late, but then people have this unrealistic expectation that they need to get on it like right now, even though they've had a list of documents, for 6, 7, 8 weeks, but people wait to the last minute.
And then think they're the only client.
They think that, yes, they think they're the only client. And then when they come back to them later on, I had a client that did this, and we had to have a come to Jesus uh, with him, where he was told how much to pay in quarterly taxes, and they actually made the second quarterly taxes, so you knew they knew what to do because they made one of them, and that was at $144,000. So that meant he missed three payments, $144,000. And then when tax time comes around, um, the preparer tells him they owe $260,000, and he flipped out. How can you do this to me? You should have been on top of this. Blah blah blah. Well, we didn't know as a tax department that they didn't make those payments. I mean, it's not like they're paying the tax department to hold their hands and make the payment. So there's all kinds of things, and they say, well, what can I do? Well, if it's before April 15th, there's very few things you can do to lower your tax benefits. You can contribute to a retirement account. And if it's a SEP, you actually can contribute quite a bit. It's a complex formula. We're not going to get into it right now, but maybe over $50,000 you could do. So that would help lower the tax benefits. It's not like a regular IRA. So they're backed in a corner as a preparer. They're getting actually what I would say is abused by clients who are stressed out because of the complexity of just running businesses, but then the complexity of the tax law. So they take it out on the preparer and they don't take personal responsibility. So then what does the preparer do? Well, you can do this and this without any strategy to help lower it. And so I don't blame them for the preparers to think it's short term, because they're in a survival mode at that
They
situation.
almost have to be reactive at that point just to
Right.
preserve a relationship or to preserve their ability to be in business the next year with clients that will stay with them. I mean, there's just a lot going on behind the scenes. And I think, I mean, Bruce, when you say that, it makes me realize that every situation that we ever find ourselves in that is frustrating, you can blame the other person, you can look at, what they're doing wrong, but usually there's some contribution that you've had to the problem to create this cause and effect and back and forth spiral that has created a situation. And I mean, really the only way out of that is taking personal ownership and responsibility. It's in a marriage, it's in parenting, it's in, any team environment you're in, it's in any leadership role, it's taking that personal responsibility.
Yeah, and to make matters worse, I just several months ago I read that since 2019, 360,000 people in the tax industry have left the tax industry. And I understand why. Now, well, at least I think I understand why. The article actually said that it
Did
was
you say 300,000 people?
360,000.
Wow.
Yeah. And it's because the tax code has become very, very confusing, and they're always changing it. That's the other part. If it was static, where they could learn on their experience and keep looking at it and get it down, then it wouldn't be bad. But it's always changing, so it's very frustrating. Then you have the lack of decorum that's coming out from people not taking personal responsibility. You can see where people are like, I don't want to be in this industry anymore, or I don't even want to get in the industry, because we have interns all the time that are looking to get in the industry, and they can see what's going on, and they decide not to get into the industry. And
Which then
so,
means if there's not quality professionals in any industry, then you have a difficult time getting your needs met in that industry. I mean, we need quality professionals in medicine and in airline pilots, and we need quality professionals in tax. But then you think about, okay, well, what in the greater system is the problem? And I mean, Bruce, I know that every time we pass a bill, you talk about the Affordable Care Act, and people just said, "Oh, that's Obamacare." This was back in what was it, 2012?
somewhere in that neighborhood, yes.
We were getting into the insurance industry at that time, and my husband Lucas and I, and we're realizing how many people were getting frustrated with the whole health insurance industry and leaving that industry because of the radical amount of changes. But I mean, most people didn't read the giant thousands of pages of documents to really understand all of what was put into that act or bill or whatever you even call it. I just think it can be so complicated when you realize that you're making what seems like a small, easy change that might benefit people, but the administrative burden of executing on those changes has to be, yes, as you're saying, all of the tax professionals then have to verse themselves in how to do that well. And so, man, I feel for people who there's people at the top who think, well, let me just make these decisions that seem in my favor in politics, and then you're in a position where all of the people who have to carry out the mechanics of that just are burdened.
Yeah, I'd like to just finish today with a couple of thoughts. So 2017, when President Trump's first administration, they implemented the 2017 Tax and Jobs Act. So that was only 8 years ago. Then we had the Secure Act that came into being. And then just a couple of years later, about 18 months, we had Secure Act 2.0. So they changed some things, interpretations of that again. And now, if Congress doesn't do anything, we are going to revert back on January 1st to the tax codes of before 2017. I don't think that's going to happen, but even if it does, you're going to have to go back to the tax codes of 2017. Congress is going to do something, I believe. I don't know if they're going to just automatically extend them. I don't think that's going to happen. And I think there's rumblings out of Congress that says they're not going to do that. They're going to modify it. Well, that modification means that at least people that were in the industry prior to 2017 would have some knowledge if it reverted back to the tax codes of 2017.
Which
But
hopefully they're still here.
yeah, if they're still here. But now that would be easier than now we're going to modify it again in 2025. And so all of this has, and my final thought today is something I went to an insurance convention a couple of weeks ago, and this person stood up and said, when you have accounts, whether it's accounts with your business, accounts receivable, accounts payable, any kind of accounts, your brokerage account, your 401k, your SEP IRA, any kind of account, that is an account that is subject to the changes in tax code.
Mm-hmm.
Okay. So you don't know what's going to happen to that account in the future because it's subject to the tax code. However, a life insurance contract is a contract. And contract, as Nelson used to say all the time, is the backbone of society. And it's been proven over and over and over that when there's laws changes, it does not affect any kind of contract. I'm not even talking about life insurance. I'm talking about any kind of contract. They cannot retroactive the contracts and change the contracts before, because that's what a contract is. It is a legal binding document, and it's going to be how it is in that contract.
Which means you start a policy today in 2025, and in 2027, the tax code changes. Your life insurance contract from 2025 is not impacted. Perhaps it will impact new life insurance contracts you put in place after the point of that contract law change, but it
Correct.
won't affect the ones that you already had in place at the time of the change.
Correct. And there's precedent on that over the last 40, 50 years that I know of, through the change of the modified endowment contract laws, through the changes of 7702 laws a couple times. Last was from the President Trump's administration going out in 2020. So there have been changes, but it does not affect the current contracts that you have in place. So if you want some certainty in it, that's another reason that you would like to have some insurance contracts, because you have certainty on how they're going to be treated tax wise, where you don't have certainty on how they're going to change the deductibility of the other accounts, or even deductibility of expenses in your business.
Okay, so Bruce, I don't know if you should do this or I should, but I think we should attempt a recap of the entire episode in about 1 minute for somebody who's just wanting to remember the main points. I'm gonna ask you, would you recap everything that we just covered today?
Sure. So the main theme today is are life insurance premiums deductible for a business, and are the interest that you pay on them deductible? It is of my opinion, although I'm not a tax person, but the people that have surrounded me would say, in general, not 100%, but in general, they are not tax deductible. Although there are ways that you can increase the deductibility of your business that would then help pay for those premiums. So that has to take in consideration. Number two, wrap up for me is that if you look at accounts versus contracts, yes, you can have all kinds of accounts. You can have savings accounts, you can have checking accounts, you can have brokerage accounts, you can have all these different accounts. They are not contracts. They are accounts. So they can change the tax treatment of those accounts. But when you have a contract, whether it's tax treatment, whether it's distribution, whether it's holding a person responsible for that contract, whatever it is, you cannot change that. You cannot retroactively change it. You can only change new contracts going forward. So when you're doing that, you want some certainties, contracts are the way to go.
Bruce, I love this episode today. I think it touches on questions that are on people's mind, specifically about how to leverage the tax code in their favor, how to do that regarding life insurance. And what I think the takeaway from this as well is that if you think about your family as a system, we've talked about on this podcast before closed systems, or having a rather than all the money just flowing out and being never seen again, where you're paying outside entities. If you're able to think about your family unit, whether that's your immediate family, your extended family, but if you're able to think about that as more of a closed system, you can think about ways to use that family and flow money within that family dynamic through a family banking system, through infinite banking or infinite banking system, and which would mean a system of life insurance policies. You can think about paying other family members. You can think about how to have a family wealth building unit. And as you do that, you have more advantages, not only in how you can use life insurance, but also how you can leverage the tax code. So with that, we're going to close today. And if you are interested in taking advantage of any of these topics or thinking them through in your own personal life, whether you're trying to make decisions about how to fund a life insurance contract, or whether you're trying to strategically figure out how to purchase an additional property, or put money into an investment deal, or buy something in your business, or start a business, whatever decisions you're trying to make today, we would love to be part of the answer to helping you make those decisions better so that you can optimize your financial life, have the most cash flow, have the most revenue, the most net worth, and be in a position of getting your money to work as hard as possible for you so you can benefit your whole family. We'd love to be part of that conversation. You can go to themoneyadvantage.com and book a call with our advisor team right on that homepage and get on our calendar. We'd encourage you to do that. And thank you again for being with us on this show. If you have following questions or follow-up questions, you can drop them into the chat wherever you're listening. If you're on a podcast and you're listening later, you can also email us at hello@themoneyadvantage. And we love to hear your questions because it helps us to be able to design educational content that helps you make even better decisions. And so we'd love to invite your questions. Thank you again, Bruce, for joining me today. And thank you for listening. To all of you listeners, go out and have a wonderful week. Remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.